Grab a good snack and settle in because today we are going to make the ultimate stock market crash course for beginners in 2022, including types of investments, how to invest, where to invest, calculating risk, picking stocks, choosing a brokerage, tax implications, and everything that you need to know to get started with investing today. All right, let's jump right into it. What is going on, everyone? I hope you are all having a fantastic day. So what we're about to cover is probably 50% of what I learned over the course of several years when I was earning my bachelor's degree in finance. But we're going to be moving fairly quickly, so be sure to use those chapter cards down in the timeline if you do need to go back to a certain section, or if you want to skip ahead to a section. And of course, if you have any questions at all, feel free to leave those down in the comment section below, and be sure to check out some of my favorite investing platforms using the links down below the like button. So let's start off with the basic question of should you invest? And I'll tell you right now that the easy answer is yes, without a doubt. Now, if you're 10 years old or drowning in hundreds of thousands of dollars in debt, then right now might not be the best time to start investing. But as a general statement, yes, you should be thinking about and planning to invest at some point in your life. And you want to get started as soon as you possibly can because time is a huge variable here. For example, if you invested $5,000 per year at an 8% annual return, that would be worth over $700,000 in 30 years. But if you waited just 5 years and only had that money invested for 25 years instead of 30, that exact same investment at the exact same return would now only be worth $450,000. But the good news is that while the best time to get started with investing was yesterday, the second best time to get started is right now, not only because there is more information available to all of us than ever before, although there is a lot of garbage out there, just a warning to you, but it's now more affordable and accessible to get started with investing than it ever has been before. Even just a few short years ago, when I got started investing, I had to pay $6.95 per trade to TD Ameritrade, but now thanks to platforms like Robinhood and M1 Finance, the entire industry has moved in the direction of no-fee trading, meaning you can literally get started with investing for free and in a lot of cases can purchase fractional shares and get started with just a few dollars. So should you invest? Absolutely. But what are the different types of investments that you can make, and how can you make sense of all of the different choices and make the best choice for you? Well, there are a million different types of investments, but let's cover the 5 core ones that you really want to focus on, that I personally focus on as well. First of all, and most importantly, we have a stock, which is sometimes referred to as an equity, and this is simply a security that represents your ownership of a fraction of a company. So if you think of Tesla, for example, as a giant pie of electric vehicles and innovation, then by purchasing a Tesla stock, you are getting a small piece of that technological advancement. Now, how small is that slice of pie? Well, that depends on the company and how many outstanding shares they have, meaning how many ways have they divided up the total pie of Tesla in this case. For Tesla, they are currently over 1 billion outstanding shares, and if you take a company's outstanding shares and multiply it by the current share price, that is how you get what's called the market capitalization, also known as market cap. And that term market cap is really important because oftentimes stocks are categorized into large cap, mid cap, and small cap, with large cap usually being $10 billion or more, mid cap being between $2 billion and $10 billion, and small cap being $300 million to $2 billion. Beyond being categorized by market capitalization, stocks can also be categorized into sectors, and currently there are 11 major sectors within the US stock market, including things like energy, financials, technology, and that sort of stuff. But lastly, stocks can also be categorized into growth stocks or income stocks or value stocks, and this really just has to do with the trajectory that that particular company and therefore that investment is headed on. A growth stock, for example, is just a company that has a lot of potential growth going forward. Very confusing, I know. While an income stock might be something that pays a regular dividend or produces some form of consistent income. A dividend, for example, is essentially a direct cash payment that a company is going to pay you as a shareholder as a thank you for investing in their company. And these dividend payouts can go really high, like 6 or 7% or even more in some cases, while other companies pay no dividend at all. All right, so outside of stocks, which are the most common form of investment, you've also got bonds, which is another type of fixed income instrument that is really just a loan made by you as an investor to a borrower who is typically a corporation or even a governmental body. Essentially, just like you would go and get a mortgage from the bank if you want to buy a house, a company or government can issue a bond if they want to build a new highway or construct a new office building or something like that. And then you have the option to lend that money to them and earn a fixed return, essentially making you the lender. Now, bonds are certainly not the most exciting form of investment, but definitely a huge staple in a well-rounded investing portfolio. But lastly, we have my 3 favorite forms of investment, which would be mutual funds, ETFs or index funds, and the new kid on the block, cryptocurrencies. Mutual funds, ETFs, and index funds are all very similar in that they are financial vehicles that are going to pull together different assets, such as the assets that we just talked about earlier, like stocks and bonds. So instead of having to buy 1,000 different hand-picked stocks on your own, which would take forever and be very difficult to do, you could instead invest in a mutual fund, index fund, or ETF, and they are then going to invest your money into a certain asset class or stock sector on your behalf. Now, the key difference here is that a mutual fund is operated by a professional and is typically actively managed by that individual. An ETF or index fund, however, is usually just tracking a particular index or stock sector or commodity, but it's purchased and sold directly on the stock exchange, just like a regular stock, and usually there is no one actively managing an index fund or ETF. Which one is better is a total different conversation, but I'll tell you that honestly, I do not invest in mutual funds anymore, and that's because over a long period of time, ETFs and index funds typically do just as well, if not better, and charge much lower fees, whereas a mutual fund is going to charge a significantly higher fee in most cases because that individual or team of financial gurus who is managing that mutual fund have to get paid their fat salaries every year. So about 90% of my personal investments across my entire portfolio are in ETFs or index funds because they typically have low fees, they're really easy to pick out, which we'll talk about in a second, and over a long period of time, they usually perform really, really well and help protect you from market volatility. But of course, lastly, we have cryptocurrencies, which you all probably know quite well, but a cryptocurrency is simply a digital form of currency that is secured by a blockchain in most cases at least. That's not always the case, but many cryptocurrencies are on what's called a decentralized network built on that blockchain, and all that really means is this is software. At the core, these cryptocurrencies are just software with a common ledger that helps verify the transactions happening within that software. I personally keep it really simple and boring and just invest in a cryptocurrency ETF, but as you all know, you can go out and buy individual Bitcoin or Ethereum or even Dogecoin if you want to go nuts. So those are the 5 core types of investments that I focus on personally, but obviously there are tons of others to choose from that can get much more complex and confusing, like options contracts, annuities, commodity trading, and even something like real estate is absolutely a form of investment. But again, I would say with an index fund or ETF, you can invest in a fund that is buying real estate or a real estate investment trust or investing in a certain commodity without you having to deal with all of those confusing complexities. So like I said earlier, the reason I love index funds and ETFs so much is because they help minimize your risk. And while risk management might not sound like the most exciting thing in the world, and it's probably not, if you're going to have success with investing, you absolutely must understand the risk versus reward of certain types of investment. This is not always the case, but the general rule of thumb when it comes to investing and life in general, I guess, is that the higher the risk, usually the higher the potential return. And that word potential is very important. When it comes to investing, you have a million different types of risk, but some of these would include your standard market risk, meaning the price of your investment obviously can go up or down and be subject to market volatility. You also have business risk, where a stock price could fall drastically due to the business not doing well or because of bad news. And depending on where you are investing and the sector that that particular company is in, you can also face liquidity risk, regulatory risk, inflationary risk, and the list goes on. You absolutely do not need to understand every single type of risk and how it applies to every investment that you are making, but this one is fairly common sense. So if Bitcoin is going up or down 10% 20% in a day, then that would be a high risk, high potential return, whereas something like a bond is usually going to offer you a consistent, maybe 3% annual return, which is a much lower risk but lower potential return. So it's easier said than done, but obviously you want to look for those investments that offer the highest potential return while still minimizing your risk as much as possible, which again is oftentimes where those ETFs and index funds would fall. All right, so we've talked about some of the types of investments, how to manage your risk, and gotten a lot of the boring stuff out of the way. So now let's answer the two big questions that many of you probably came here wondering, and that is, how do you pick your investments and how do you actually go about making your first investment? Well, if you decide to go down the path of choosing individual stocks, then the strategy that I always stick to personally is just invest in what you know. I know that that is really cliche and boring advice, and a lot of people might disagree with that, but I personally think that if you are just getting started with investing, especially in individual companies, then you are way better off just investing in what you know. But of course, beyond that, you also want to look at the company's balance sheet, look at their income statement, which would be their revenue minus any expenses, operating costs, taxes, and all of that stuff, and understand their net income. And you can also look at their cash flow statements, which include things like their operating cash flow for business activity, their investment cash flow for their properties and other assets, and their capex, which would be their capital expenditure. And then lastly, you also have their financing cash flows, which means how much money is changing hands from the business that you want to invest in to their different creditors and lenders if they have taken on debt. Trust me, I know that all of that is incredibly boring and sounds very confusing and time consuming, but if you were looking to make the investment in individual stocks, then that is really what you're signing up for if you want to succeed. But if you're like me and you are really lazy and you don't want to do any of that crap, then honestly, don't make it more complicated than it has to be. Remember that an index fund or ETF is already diversifying your money across hundreds or thousands of different companies in some cases, so that means that you don't need to own 100 different index funds in order to diversify your money. I know a lot of people, myself included, who just own one index fund for each different investment type or asset class, and that's it. Plus, major fund providers like Vanguard or Fidelity make it really easy because they offer index funds and ETFs for specific market sectors or entire markets, so you can literally do an easy Google search for the best Vanguard US stock market index fund, learn a little bit about your different options, and then make an informed decision. But you can actually remove yourself even further from that process if you are really lazy like me, and that brings us to the final section of today's video, which would be, how do you actually make your first investment? Well, like I said at the beginning of today's video, it is easier and cheaper than ever before to get started with investing. So the first thing that you want to do is choose what's called a brokerage, and nowadays there are plenty to choose from. When I started, I used TD Ameritrade, but I've since left that behind and used several more modern options like Webull, Robinhood, M1 Finance, Wealthfront, and SoFi Invest. Today's video is not to figure out what brokerage is best, but I have made a ton of videos talking about that very topic in the past, so I will link to that down below the like button. But in general, platforms like TD Ameritrade, Vanguard, and Fidelity are going to give you that more robust desktop-based experience, while platforms like Robinhood, M1 Finance, and SoFi Invest are mostly going to be done right from your smartphone. That's not to say that you can't pull up that detailed information from your smartphone or use a computer with those platforms, but if you're like me and you'd rather just have everything on your phone, then one of those more modern apps is probably your best bet. If you're wondering what platform I personally use, like I said earlier, I'm really lazy and I actually use a platform called Wealthfront, which I've talked about at length in previous videos, but this is a fully automated investing platform, meaning you literally just transfer money into your Wealthfront accounts, answer a few questions so that they understand your risk tolerance and what your investing goals are, and then they are literally going to buy index funds and ETFs and real estate investment trusts and bonds and all of that stuff on your behalf without you having to do anything. This video and this channel have never been sponsored by Wealthfront, as cool as that would be, but I do really love this platform, and because I'm really lazy, this is the best option for me. So if you do want to check out Wealthfront and learn more, I will leave a link for that down below the like button, where you can get your first $5,000 of investments managed for completely free. Now, the last thing we have to talk about before we wrap up this longer video is the difference between short-term capital gains and long-term capital gains. Just wait, I know this sounds really boring, but this is incredibly important, and you have to understand this because otherwise it could cost you a ton of money. So in a nutshell, short-term capital gains, or losses for that matter, is if you were to buy and sell an investment in under 1 year. And that means that that gain, if there was any, would be taxed at your regular taxable income. But the US wants to incentivize you to invest for longer periods of time. So long-term capital gains tax, meaning if you hold that investment for more than 1 year, is either 0%, 15%, or 25% at the time of recording this video, depending on your filing status and income. But in pretty much every possible scenario, you are going to pay significantly lower taxes on your long-term capital gains than if you were to sell in a short period of time and have to pay your regular income tax. All right, I know we moved really fast through all of that, and I threw a lot of information at you in a very short period of time, but I hate to break it to you, we really just scratched the surface of everything that you could learn about investing. Be sure to check out some of my favorite financial tools using those links down below the like button, many of which will give you some free cash and other bonuses when you sign up, which we always love. Of course, thank you so much for your time. I really do appreciate it so much. Take it easy, and I'll see you in the next one.